Hello and welcome back to the Note. We've had a relatively calm end to what was quite a busy week. As for the week ahead, I'd like to put in context the one big event that at this moment swamps anything else that we can foresee, which is of course the British referendum on whether to leave the European Union. Now it's obviously a very big deal for those of us who are British, but it does have very broad ramifications across the world. I'd like to provide a couple of ways to frame what matters. Now, first of all, perhaps most directly, this referendum could affect the pound sterling. Now, what we're looking at here is the pound against the dollar going back to 1985, when it very nearly dropped to parity against the dollar. Shortly after that, we saw the Plaza Accord. And since then, you can see very reliably, the pound has virtually never breached $1.40. Whenever it has done so, it has rebounded very quickly thereafter. It did so earlier this year. It has obviously fallen somewhat against the dollar as concerns over Brexit have increased this year. If the current odds are that it's a little bit more than a third chance that Britain leaves, then plainly there is a chance, if it actually happens, that we will drop below 140 once more and actually hit a low that hasn't been seen since the time of Plaza. If that happens, foreign exchange markets are very much driven by chart analysis like this. If that happens, then the implication, which is quite worrying, is that there simply will not be an obvious floor for sterling. The risk that you could see a very sharp run on sterling plainly does exist in the event of an exit vote. There are plainly plenty of reasons why you might still want to vote for such a thing, but plainly the risk is there in the forex markets. Now let's take a look at Europe, and plainly the other great area of concern about a British exit is the possibility that it would destabilise the rest of the Union, which had enough of its own internally generated problems over the last few years, and by setting a precedent for an exit would make it that much more possible for other countries to leave, possibly even for countries to leave the Eurozone, of which the UK, of course, has never been a member. Now, let's take a look to try to gauge this at a chart that we haven't looked at for a while, but that was all the rage during the worst of the Eurozone crisis. This is the spread of Spanish over German 10-year bond yields. Obviously, the higher this spread, the greater the perceived risk of Spain compared to Germany, and implicitly the greater the perceived risk that there may be a need for a fracturing of the Eurozone, for departures from the Eurozone. As you can see, there is nothing in the way of tension in the moment in the Eurozone to remotely match what we saw in the worst years of the crisis back in 2011, 2012 and 2013. But you do see that tensions have risen appreciably. That spread has been at its highest for some 2 years of late. I think if we really are going to see some kind of a precedent set, you can make two judgments on this. First of all, there is a belief that outside of Greece, the risks to the Eurozone have now safely been quarantined. But secondly, that does imply that the potential risks of a revival in tensions, the potential risks that would come with the Brexit, have really only barely been priced in to the Eurozone. There are plenty of other measures which we've discussed at length this week already, such as remarkably low bond yields, particularly in the US and Germany, and the high price of gold. There are plenty of other ways in which people are obviously taking refuge in safe havens ahead of this event. If you look at the long term, though, it is obvious that there is still quite a lot further for sterling to fall if this really does happen, and that the risks to the Eurozone are not at this point judged as very high at all. Moments to think of ahead of what could be a very momentous week for Britain and Europe.